$5,000 just erased the old rulebook. Gold didn't drift higher. It detonated past $5,000 an ounce, a level experts said shouldn't arrive this fast. In 12 months, the price jumped 84%. Silver didn't lag behind. It went nearly vertical, surging roughly 250% toward $110 an ounce. These are facts on the screen, not opinions. Markets are now openly calling this uncharted territory where resistance levels no longer matter. Here's the paradox. This isn't how inflation trades. This is how fear trades. The move isn't gradual, it's urgent. And when money moves with urgency, it's not chasing upside, it's running from something else. That matters to you because the same systems holding your savings, your job, and your currency are the ones being quietly repriced right now. But here's the part nobody is saying out loud. Gold doesn't behave like this unless confidence has already snapped somewhere else. The price is reacting to a shock you're not being shown yet. So what exactly broke first? To understand what's happening, you have to zoom out before you zoom in. This move didn't start with a single headline or one bad data point. It started with a pattern. Capital is flooding into gold and silver, not because traders suddenly love metals, but because trust is draining out of everything else. The rally looks sharp because the underlying fear is sharp. The core event is simple on paper. Gold above 5,000, silver above 100, massive gains in a single year. But only about 60% of the story is visible in the prices themselves. The rest sits in the backdrop. Global institutions are issuing warnings. The language has shifted from stability to survival. The United Nations Secretary General is openly saying the international order is giving way to the law of the jungle. That phrase alone is enough to rattle markets. Here's the reframing question most people miss. If investors believed rules still mattered, would they be buying metal this aggressively? Or are they preparing for a world where contracts, courts, and guarantees don't work the way they used to? This is where the story stops being about prices and starts being about power. Here's the claim that makes this uncomfortable. Markets are no longer hedging inflation, they're hedging disorder, and the evidence is hiding in plain sight. The strongest signal isn't just the price of gold, it's the speed. An 84% move in a year doesn't happen in a calm system. Silver climbing roughly 250% doesn't happen in a functioning one. These are not trades built on patience. They are reactions built on urgency. The content itself calls this a flight to safety, so intense it signals fear that institutions designed to keep the peace are now powerless. Look at the language being used. Uncharted territory. Total systemic recalibration. Those aren't phrases markets use when they expect stability. They're used when old assumptions are being thrown out. And notice what's missing from this rally. There's no celebration, no confidence, no sense that this is a healthy boom. The buying is defensive, not optimistic. Here's why that detail changes everything. When markets stop trusting rules, they stop pricing futures and start pricing exits. Gold isn't rising because people believe in growth. It's rising because they don't believe in protection anymore. And once that belief cracks, it rarely stays contained. Now watch how fast this escalates. The fear in markets didn't stay abstract for long. It found a trigger. The geopolitical temperature didn't just rise, it boiled. The US president publicly warned of a massive fleet aimed at Iran, adding, "We have an armada, maybe we won't have to use it." That isn't background noise. That is a direct reference to kinetic military force involving naval strike power in one of the most sensitive regions on Earth. Markets reacted immediately because an armada in the Middle East isn't symbolic. It sits on top of the world's energy arteries, shipping lanes, oil flows, insurance risk. One miscalculation that doesn't stay local. Historically, moments like this don't need shots fired to move markets. The threat alone is enough. We've seen this pattern before. When military language replaces diplomatic language, volatility becomes normal. Here's the part that shouldn't be normal but suddenly is. Statements that once would have caused emergency summits are now being delivered casually, on camera, with markets expected to absorb the shock. That normalization is dangerous, because when escalation becomes routine, investors stop assuming restraint. And when restraint disappears, safe havens stop being optional. This is where the story flips. While attention stays locked on the Middle East, a second shock hits from a direction almost no one expected. Greenland, a place most people associate with ice, not escalation. And yet the content is explicit. The United States is now threatening the deployment of military personnel and the use of tariffs against countries that oppose American control over the territory. That's not diplomacy. That's leverage through force. Here's the contradiction that matters. This is happening under the banner of stability, while introducing a brand new militarized front in the Arctic. Greenland isn't just land, it's access, resources, shipping routes opening as ice retreats, strategic positioning in a world that's running out of neutral ground. Markets understand this immediately. Algorithms don't need a history lesson to see risks stacking up. And notice the gap between words and impact. Officials frame this as precaution. Markets price it as precedent. Because once geography becomes weaponized, nothing stays off limits. The buying in metals accelerates not because this is one crisis, but because it proves crises can now appear anywhere. That realization permanently changes how risk is calculated. Pressure doesn't build slowly anymore. It stacks. Almost immediately, the trade war mutates into something more extreme. The United States issues an ultimatum to Canada. Sign a trade deal with Beijing, and a 100% tariff hits instantly. No phased response, no negotiation window. The threat is delivered publicly on Truth Social, bypassing traditional diplomatic channels entirely. That speed matters. It removes friction, and friction is what used to prevent panic. At the same time, silver starts behaving unlike anything in modern market history. Prices don't climb, they lunge. Roughly 225 to 250% gains in a year, blasting through $100 an ounce toward $110. This isn't enthusiasm, it's scarcity colliding with urgency. The market is thin, the exits are narrow, and buyers are rushing in all at once. Add one more layer. Global investors are watching military threats, tariff ultimatums, and vertical price moves unfold simultaneously. There's no pause, no reset, just acceleration. Control slips when too many shocks arrive too fast for systems to process them. And that leads to the question no one wants to answer yet. Now bring it back to where this actually lands, on you. Because this isn't a chart-only story. When gold and silver move like this, it doesn't stay inside trading desks. It leaks into daily life. Supply chains feel it first, prices follow. When a 100% tariff can be triggered instantly by a single signature, businesses don't wait. They preemptively raise costs, they stockpile, they pull back, and those decisions ripple outward fast. Energy risk pushes transport costs higher. Metal scarcity squeezes manufacturers. Electronics, vehicles, infrastructure, even basic consumer goods quietly become more expensive or harder to source. You don't see a headline that says, "This is why your costs just jumped." You just feel it. Slower hiring, tighter budgets, less margin for error. And here's the unsettling part. None of this requires a full-blown crisis to happen. It only requires uncertainty to persist. Markets are already acting as if instability is the baseline. That assumption bleeds into the real economy long before anyone officially declares an emergency. If this feels familiar, say so in the comments, because millions of people are sensing the pressure without seeing the cause. And the forces driving it aren't accidental. Here's where the story gets quieter and more dangerous. Because this isn't chaos. It's a system responding exactly as it's built to. The mechanism is simple. When power becomes unpredictable, capital looks for assets with no counterparty. Gold doesn't need a court. Silver doesn't need a promise. They don't depend on institutions behaving well. And right now, institutions are signaling the opposite. Look at the incentives. Governments use leverage because it works fast. Threats, tariffs, deployments, they create immediate pressure. But each time they're used, credibility erodes a little more. Markets learn the lesson quicker than voters do. They stop trusting stability and start pricing volatility as permanent. This is why traditional tools feel useless. Rate cuts, statements, reassurance, none of them address the core issue. The issue isn't liquidity, It's confidence. And confidence, once lost, doesn't come back with a press conference. That's why the Federal Reserve looks trapped, why institutions sound reactive instead of in control. This is the insight most coverage misses. Gold isn't rising because the system is failing. It's rising because the system is functioning exactly as designed, concentrating power, amplifying risk, and pushing everyone else to hedge the consequences. And that brings us to what comes next. From here, the path splits, but neither option is calm. One path is containment, tensions cool just enough. Threats stay threats, tariffs become bargaining chips instead of triggers. In that scenario, gold and silver don't collapse, they consolidate. Prices stay high because the memory of risk doesn't vanish. Investors don't unlearn fear overnight. The market accepts a new baseline where $5,000 gold isn't shocking anymore, it's insurance. The other path is acceleration. Diplomatic language continues to erode. Social media posts replace back channels. One misstep, one enforcement of a threat, one real disruption to energy, trade, or supply chains. And markets don't wait for confirmation. They front-run the damage. In that world, metals don't pause. They gap higher because everyone tries to hedge at the same time. Notice the uncertainty here. There's no clean forecasts, no stable middle ground. Momentum is already in motion, and the next move doesn't require a new crisis, just the absence of reassurance. Markets are leaning forward, not sitting back, and the unsettling part is this. The decision point may already be passing quietly, while attention is somewhere else. Here's the insight that ties all of this together. Gold at $5,000 isn't the story. It's the symptom. The real signal is that markets are no longer betting on resolution. They're betting on endurance, on the ability to survive a world where rules bend, warnings escalate, and certainty keeps shrinking. When money chooses metal over systems, it's making a statement about trust, not price. Reframe the entire move this way. This isn't a rally driven by greed. It's a recalibration driven by realism. Investors aren't asking how high gold can go. They're asking what still works when everything else becomes conditional. And that's the loop that stays open, because none of the forces behind this move are finished. They're still unfolding, still stacking, still accelerating under the surface. If you want to understand what breaks next and what quietly holds, follow and subscribe. The next layer of this story is already forming, whether the headlines catch up or not.